This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
It is Wednesday, April 20th, 2016. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly, but leave you to examine all of them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are solely for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates global risk. Therefore, the slides this morning will focus on our other three report areas of the GMTP report, the global macro, regional, and U.S. economic developments. In this regard, I'd like to discuss the following this morning, shown here, some of which I've discussed in other recent reports, but I wanted to pull some of my messages together regarding global risk. In the April monthly market commentary, the MMC, I spelled out how we are crippling the capitalist system by not reinvesting our domestic savings and profits, corporate profits, back into truly productive assets, which will then generate productivity gains and thereby lead to overall increases in the standard of living. As a consequence, we are seeing falling standards of living for the entire middle class of America. Simply said, a healthy economy produces more than it consumes. A functioning capitalist system is about getting more for less through competition and free markets. This is no longer what we have in America. We now consume more than we produce, and as a consequence, we are now getting less for more. This is what happens as a direct consequence of both insufficient savings in lieu of consumption and corporate profits being incorrectly allocated. This misallocation of capital occurs when risk is not priced properly, there is ineffective price discovery, and malinvestment becomes prevalent, often due to moral hazard and unintended consequences and of poor public policy. The root cause of this behavior is the financialization of the U.S. economy. When financial corporations begin to dominate the economy and financial engineering is perceived to be the shortest and easiest path to profits, then the game of risk avoidance becomes center stage. When this occurs, investing in productive assets becomes increasingly more risky and less profitable than investing simply in financial profits using cheap money to facilitate leverage and the gearing on the balance sheet. Even non-financial corporations become more profitable as cheap money removes interest expense and capital costs. It is the greatest time for corporate profits when you have cheap money for protracted periods of time. But the question is whether it is sustainable, or is it really about steadily killing the golden goose that created the party in the first place, or the great economy that the U.S. has been blessed to have had for 100 years? The financial game is about cheap money. The game began with Federal Reserve Chairman Alan Greenspan, then called the Great Maestro because of the rabbits he would pull out of the hat and the magic that he would create. But how he did it is he used cheap money to address every hiccup in the economy, from the Asian crisis to LTCM to Y2K, etc. I lived through every one of them, and I was stunned that it was always the same card that he'd pull out. By doing this, it changed the dynamics on risk through beliefs such as the Greenspan put, and everybody played it. This misplaced policy stance became even more entrenched after the 2008 crisis, as unheard of and untested monetary initiatives such as quantitative easing and ZIRP began to dominate. We have witnessed cheap money for an unprecedented period of 7 years. These policies have contributed to increased government debt levels, which now the U.S. government is incapable of financing or rolling over its outstanding debt if rates were to rise as little as 1.5%. They have trapped themselves as a result of these protracted policy and for a protracted period of time. What we have is what I have long termed and related in these videos, something called monetary malpractice. How it evolves, what's involved in it, and we've discussed every one of these labels on this particular chart. Despite this, we are still going to see new central bank initiatives in 2016 that will shock most, yourself and myself included. Central banks have little choice but to continue on this road. For example, why would investors place $7 trillion in bonds with negative interest rates? Or to put it another way, why would they pay someone to take their money? Other than possible currency appreciation or expected NIRP yields that will fall even lower, it is about paying for the safety of those assets that they have. It is about the return of their capital, not the return on their capital. It's called fear. They're afraid. They want to make sure they're going to get those assets back, even if they're not at the same value or purchasing power that they had when they put them in. I've done a lot of work at the Financial Repression Authority, which, as you're probably aware, I co-founded, to determine where the central banks are headed. It has been my documented view we will see NIRP, OMF, or overt monetary financing, what is often called helicopter money, and new rounds of quantitative easing in a not too distant future, maybe even followed by collateral guarantees, the government, the central banks buying equities, etc. It is going to only get worse until something breaks. But when might this breakage occur? We need to step back to answer that question. Certainly this must have happened before or had precedences. First, consider the following headwinds. Technology. It's advancing and at a staggering rate. Internets, robotics, software. I believe it's only at the early stages of the gains that it'll make. These gains are cost cutting. These gains are cutting labor. And this is the wave that's coming. I expect it to come to retail fairly soon in a massive way. Demographics, the baby boom and aging societies and what it means. We're going to talk a little bit more about that in a moment. And slowing global growth. I didn't say it wasn't growing, though I would argue it's actually contracting, but minimally well documented that it's slowing. The first derivative. That's the issue. It's the rate of slowing that is a massive problem right now, and the adjustments to the supply chain, etc., that go with those adjustments. These are tremendous deflationary pressures that run counter to government and central bankers' stated objective of targeting inflation rates of 2%. It is a battle that so far the central banks have not won, despite massive increases in the money supply and central bank balance sheets. Money printing and debt creation is growing faster than the economy is growing, which is making debt payments every day even more onerous. As this chart shows, the problem is that the debt is being spent on the wrong things, and as I said, is growing 3 times faster than the GDP. The problem is that the money is not going into business investment. Corporations, as you can see here, increased debt by $793 billion in 2015. But when you look at the GDP formula, gross private investments in the GDP calculation grew by only $161 billion. Corporations are playing the financial engineering game of stock buybacks and dividend payouts. They are not investing in growth. I've argued why that is in other reports. It would seem we are trapped by bad policies practiced for a sustained period of time. The question we might ask also is, has this ever occurred before in history? And if so, how was it resolved then? Consider the long-term cycle called the Kondratiev cycle, which is a generational cycle. Interest rates are dominated by this 60-year Kondratiev cycle. The next major bottom for interest rates is ideally due about now. With U.S. yields close to a 220-year low, we are approaching the natural end of a 35-year period of declining interest rates. This is a more detailed look at that Kondratiev cycle. Pay particular attention to the U.S. total debt as a percent of GDP. It is higher and has lasted much longer than the cycle would have suggested. This is the direct result of a sustained bad monetary policy. It has artificially kicked the can down the road and sustained equity markets longer than would otherwise have been expected. Something is therefore overdue, still ahead, and according to this 220-year documented generational cycle, is going to be fairly violent. I recently interviewed Martin Armstrong, the developer of the very well-regarded economic confidence model shown here. His model suggests a very difficult period beginning in 2016, and with counter-rallies being with us and continuing downward until 2020. I also recently interviewed Harry Dent, the globally recognized authority on how demographics impact economies and consumer spending patterns. He shows that the spending behavior is significantly impacting the economy to the downside. Once the engine of consumption, the baby boomer generation, is now creating massive economic headwinds. It shows here that the average age was 39 years old in 2000 of the baby boomer generation. Today, it's 54 years old in 2015. When Dent's spending cycle is overlaid onto the Dow, adjusted for inflation, we see the following chart. What is critical here, he sees an expected decline in spending from 2003 through 2022, shown by this straight red line. Harry Dent also did extensive work in developing another cycle that is much less well known and I found very fascinating. It is what he calls the 35-year geopolitical cycle, shown here in red. You will notice how it is in a falling trend until 2020. Also notice how his shorter-term 10-year boom-bust cycle at the bottom, shown in green, associated with innovation, is also heading down through exactly the same period of time. A preponderance of concerns seems to be evident and overlapping here. I have written recently on the Shanghai Accord, which we believe occurred at the recent February G20 meeting. Our analysis of the duration of this accord and the overall direction of the US dollar is shown by the blue arrows at the top of this chart. We thought to overlay it then with Martin Armstrong's economic confidence model, and we were surprised to see the degree of correlation with our perceptions of evolving changes regarding only the US dollar. All of these independent cycles are pointing in the same direction, same time frame, for various different reasons, but all provable in terms of what is happening. Maybe the time frame isn't provable, but it's suggestible. Something bad lies ahead. We believe what these economic cycles are telling us is there is a massive social change in the process of occurring as we talk. A change being brought on by a lost faith in the system. Our annual thesis this year was entitled Crisis of Trust. Last year it was entitled Fiduciary Failure. The titles are telling about an increasing degree of lost faith in the status quo. We didn't write it because of that. We wrote it for what our abstraction models were indicating as an evolution. But we're starting to really conclude that this is what's at the root of it. Inequality has become so blatant that the current U.S. presidential primaries, as an example, have been set on their ear by massive turnout for candidates who are talking about the degree of corruption, incompetence, ineffectiveness of the U.S. government. At least that's what I'm hearing. People are voting with their middle index finger and it's pointed at the government. People are frustrated and they're beginning to get angry. The citizenship, if I can call it that, now believes that the system is no longer working for them. That's what I'm hearing. They see that when they do all the right things, that is, go to school, go to graduate school, train, work hard, it no longer delivers on what the expectations were if you did that. The American dream is no longer a reality to the vast majority of Americans. It's a broken dream. What has happened is a social contract is broken down. What's the social contract? The social contract is the unwritten agreement, the unwritten understanding between the citizenship of a government, of a country, and its government. And that is that if a person does the right things, the government will create and has the responsibility of delivering an environment such that they will be rewarded for having done that. Instead, what they now see is not only is this not happening,
But those closest to the government, such as crony capitalists, government employees, those living off the government, are doing well, but everyone else is hurting. People see government employees having pensions. Nobody in the private sector has such a thing. They see government employees having health coverage. They see themselves not having any kind of real health coverage that's affordable, etc. Corruption is often tolerated by the citizenship until a person can no longer live the life they want. They then resent and begin resenting the government freeloaders, and they begin to demand change. When they can't support their family, they then revolt. It's when they can't feed their family or maintain their family in any kind of reasonable lifestyle that they revolt. We may be nearing that point in America. More frightening than that, this may not be unique to America, as we see similar fringe parties taking dominant positions around the world. The status quo in social contract is now under fire in almost all developed economies. Promised entitlements are now being called into question as time has come for the government to deliver on those promises, and people don't believe that they're there, and they've come to depend on them being there. When you combine monetary policy problems, economic developments that we're seeing, and growing inequality we just talked about, and overlay it on the financial markets, it becomes a major concern. This chart from Harry Dent calls for the results to be a 70% drop in stocks by the end of 2017. And remember, Harry Dent was the person who was screaming in the early 90s about the boom that he saw coming through the end of the decade into 2007. He actually was talking about Dow 20,000 at one point. People thought he was an optimistic lunatic. Now he's talking as though he's one of the most negative bears out there. He can be, maybe he's wrong to the degree, but he's certainly been right on the direction. We're already seeing around the top, again, this is a chart from Harry Dent, and you'll notice he has a scenario 2 which very much resembles our M-top that we've been long calling. 3 years ago, I predicted the M-top, where the inside strength of the M would be reversed due to an unprecedented central bank policy, which would trigger the beginning of a potential Minsky melt-up. Here's that chart from last month. I'm not sure if we get a higher high, double top, or 61.8 Fibonacci retracement from the lows. And by the way, we're at that 61.8 and higher as we talk. What I do believe is we are near the point where the central banks will soon take action to trigger a potential melt-up. I ask you, what would happen to stocks if the Federal Reserve said it was going to start buying equities, like the Bank of Japan is already doing with the Nikkei and other central banks are also doing? It is reported the governments and their central banks have already purchased over $29 trillion in public assets. Would that cause a melt-up? At least temporarily, while the currency used to purchase the assets is perceived to be of some value? I think we're getting close. Time will tell if the central banks can pull yet another rabbit from the hat, which we've got accustomed to them doing. But at some point, they're just going to run out of rabbits. In closing, remember the answer has been, and we've been saying this for 7 years, will be to print more money. It's the only answer politicians will ever agree on. Invest accordingly. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2016 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.